Hello, everybody. Welcome back to my Daily Dose with Tim. Today is season 3, episode 54, and we are going to continue on the subject of creative financing. And right now, actually, we're focusing on a very, very critical subject, and we're comparing cash on cash return versus cash flow versus return on investment. And in the last episode, I ended on a bit of a question for everybody as well. So I'm going to pull up the slides so that you can take a very close look at what the numbers are like again. And if you have not followed this subject since, I believe, episode 46, make sure you go back and start from there so that the dots will connect for you. And also, this morning, I did receive a very last minute request in my email from one of you to say, hey, you know what, I've been looking at your home market, which is Edmonton, Alberta, and I got this deal opportunity from a realtor that I connected with. So can you take a quick look? Absolutely, I can. Just so you know, I'm going to be literally doing this live with you. No different than, let's say, when I'm on a mentorship with my students and in between meetings and property viewings, we maybe go to a Starbucks, sit down and start to crunch numbers. Okay. So coming back here, I know a lot of you guys are kind of confused about why is it 27%? Remember, when we started this particular portion to compare cash on cash versus cash on cash return versus cash flow versus return on investment, I gave you a very simple formula. Before we get in there, though, let's take a look at the last scenario first so that you are able to really take a look at the difference between the two of them. So the last scenario here is if cash flow is $4,000 for the year, for example, appreciation is minus $1,000 because, well, the market's turning and it's really happening a lot in a lot of the North American markets at the moment. So what happens? Well, let's take a look first. Cash on cash return in this particular case actually increases to 40%, even better than the first scenario where cash flow is $3,000 and without any appreciation or with minus or negative appreciation, cash on cash is still 40%. And then you have an overall return on investment of 30%. And so if you remember in the previous episode, how logically we run the numbers will likely be, okay, well, now we can say because cash flow is cash into our pocket now. So that is what we call realized income, realized revenue, and taking out the appreciation, assuming that you've actually reported it on your tax filing to claim appreciation. It is minus $1,000, or maybe you've sold the property for whatever reason. Point is, the appreciation is actually realized. And so in this particular case, it is now 4,000 minus 1,000. So there you have your 3,000 divided by your initial investment of $10,000. And so right here, we have a return on investment of 30%. And so excuse me, still swinging back from whatever this has been. And so coming back here, and I apologize for the nasal sounds still, I'm doing my best and I'm honoring my commitment. I know one of you also shared with me the fact that if my value is health, maybe I should have taken a break. You know what? You're right. I'm not going to dispute that. And so what I'm going to do is I'm definitely going to dedicate myself today still to full recovery mode rather than pushing myself through so that I can get better faster. So thank you for the reminder. Now coming back here though, so I wanted to really take a look at the previous scenario. And here I'm going to bring you back to this particular equation of defining return on investment. I want you to remember that a lot of people tend to think that cash flow is realized, okay? As in, it is money into the bank account, it is money into the pocket, and appreciation, if you're hanging on to it, or in some cases, depreciation, if you have not capitalized on it, it doesn't count. Well, again, remember, this is where the amateur buyers and the educated investors actually separate. Because if you remember this particular formula, this calculation will make a whole lot more sense in terms of how we got to 27%. Okay, so if you think about it, minus 10,000 in cash flow, that is very, very real. It is 10%. It is 10% of your initial investment. Okay, and then technically, if you add cash flow and appreciation together, because you got to do that before we can determine the ROI against the time frame. Remember, how much in, how much out, how long really is the formula for calculating ROI. How long as in beginning to end, whatever that endpoint is, as I just mentioned. And so really, the overall realized gain is still 3,000, okay? And so that is 30%. And yet, if you want to take out the 10% on paper, 10% on paper of your total realized ROI, it's 10% of the 30% ROI, which means it brings the 30% down to 27%. I understand, and there might still be some confusion there because I know I sure did when I first was learning about this. I just want to remind you to keep going back to that particular formula, okay? And so now what I want to do is, as I said, it's an impromptu. Hang on a second. I'm not going to be sharing this anymore. I'm going to be doing an impromptu deal analysis with some of you. And how am I going to do this is I am going to basically start a fresh sheet here. Probably should have prepped for this. However, this is as live as it gets, including me coughing and sneezing in front of you all. Because, yeah, like I said, none of these are scripted. And you literally just sent me this morning, like literally about 25 minutes before I was about to go live. So here we go. And so I took a quick screenshot of the deal here. So I'm going to write this out for everybody. That way you can actually follow it. So this is what we call a suite of property. Here we go. Where is it? Okay. So this is a suite of property in Edmonton, Alberta. And what that means is if you're in the West Coast and you're in a different place, right now in this particular case, it's actually up, down. Okay. So I'm going to do up, down, suite it properly. And I know out east in Canada, you call this a duplex, okay? We actually don't call it a duplex out west here, simply because a duplex actually in this particular case for us would be under the same roof, however, two different titles. In this particular case, because it's one title, so it's suited. That means two self-sustained and self-contained units, meaning they have functioning bathrooms and also functioning kitchens that are built to code. So right here, the asking price, let me double check here. So the asking price, where did it go? Where did it go? Okay, here we go. The asking price is $389,400. For many of you, this is very, very attractive because you may come from a market where that is not even a 20% down payment for some of you. And it goes rent upstairs is about it says 1,447, which is a very odd number, plus 150 for garage rental. And then basement is renting for 1,097 plus 200 utility fee. And so this is, again, current performance. And I'm just going to say, because I'm not using a spreadsheet right now, I just really want to walk you through some of the high level thought process, because the idea is for you to go back with some questions so that when you're running your own numbers, you are able to calculate your own numbers. I always say whatever numbers are given to you, it's a baseline, it's a frame of reference, including the asking price, okay? And so it also says right now, leases will expire on September 1st, 2023, which is coming up. And what that means is it's great. And again, knowing Alberta, what that means is you're actually able to increase the rent at that point if you like to. Again, you do need to give a certain amount of notice, typically 60 days, which means we're already within that time frame, seeing that today is July 20th already. However, if it's a change of ownership and there was never any sort of extension discussed, you are able to make that change. At the same time, though, as an ethical landlord would or investor would, you would definitely provide some timeline so that the tenants can actually respond and react to it. Okay, so with that said, first thing first, clearly I would basically do a comp. So here are some of the steps that I would do right now if this deal was on my desk today and that I might be interested in. Just so you know, I'm not, so don't worry about it. And this is the thing. I mean, I always tell my students that whatever deals, whatever relationships that you build during your mentorships, it is all your relationships to keep and your deals to do. Not for us. This is education only. So first thing first, you obviously want to do comps. At the same time, as soon as your comps are done from the realtor, you want to basically make an offer, tie it down, get it under contract one way or another, okay? Because once you have an accepted offer, typically speaking, you can start the financing application. Remember, you always want to make sure that you have financing in place before you actually schedule for an inspection. Now, depending on the market condition, I understand some of you may have just come out of a very hot market. For example, in Ontario, during COVID especially, if you did not come in with cash offer unconditional, you're probably not competitive. However, the waves are really not rolling that way anymore. And so as buyers, you do have a bit more leeway these days in most markets. And I will say that remains the case in my market still. Now, granted, because of supply and demand right now, it is still depending on the seller's motivation and situation, it might be a little bit different. And clearly, after all of these things are done, you might be able to renegotiate, okay? Now, while you're making an offer at the same time, though, what you might potentially want to do here is verify the current leases, because this is still considered a small multi, because you're not just dealing with a single tenant, a single lease anymore. You want to verify leases, verify expenses that for major repairs, okay? And depending on when the last major renovation was done, ask for any warranty, okay, certificates that could be potentially passed down to you, and maintenance schedule, meaning when was the last time they did any sort of major maintenance? For example, was there any sort of roof repairs? Was there any sort of furnace cleaning? So on and so forth, depending on what's actually on site and within the property. And again, coming back to verifying the leases, right now for me, I would actually also find out what fair market rent is. This, you can do some self-studies, do some research on your own, or you can contact a property manager or property management company, or multiple of them if you like, to back up your own research too. And one biggest thing that I am actually really curious about is the garage rental charge as well as the utility fee. Yes, in my home market, it's very, very common that the detached garages could be rented out separately. However, more often than not, if the tenant is actually on site, then we tend to say we give a special discount. So my question now is the 150 garage rental, first of all, tied to the actual residential lease? And second of all, can the garage rental be rented out higher if it's not rented to the tenant on site? Meaning, was there an incentive given? And also, in terms of timeline on lease, on both leases, are they tied together or are they separate in the first place? Okay. And the other thing is, in terms of basement at 1097, it's really interesting. All these numbers, I think I can see what they're doing here. However, it's just a little odd. And in all honesty, I do have the address of this listing. However, this is not what this is about. And so I don't want to reveal your private and confidential information, first of all. Second of all, this is not my deal. This is your deal. And so I don't want anybody to scoop your deal because this is education only. And so again, psychologically speaking, from a marketing standpoint, the rents that end in 7 is very much like if you've ever seen a Walmart ads or walked into a Walmart these days. As I mentioned, it's very difficult for me to walk into a Walmart these days for many reasons. And so the whole idea is that psychologically speaking, from a marketing standpoint, prices that end in 7 gives people the illusion that it's a lot less than what it is. Because again, if you think about it, $1,447 for rent for upstairs technically is $1,450. And in the basement, technically, it's really $1,100. However, shaving off $3 makes it look that much more attractive. No different than when you see prices that are at, let's say, ending at a 9 or ending at 99 cents. It really changes the perception, okay? And so basement utility fee, that's the part that actually puzzles me. So that will definitely make sure that when I'm verifying the leases, I would also actually asking to justify the garage rental, as we mentioned, and utility fees, and wondering if the tenants are actually paying for their own utility bills, or if the landlord or the potential investor in this case is actually paying for it. And if that's the case, if the basement is paying for utility fee, does that mean the upstairs tenant is paying for the whole bill? And so the basement just needs to contribute to it and then you reimburse it? Or are you responsible for the entire bill, which means upstairs, why are they not paying utility fees? Or has the lease that's been set up meant to assume the utility bills? So these are some of the typical steps that I would do, and renegotiating could happen or not, depending on how you want to approach this. And again, I have not had a chance to do a comp yet, so I don't know if 389,400 in this particular case is fair market value, or is it lower or higher? Meaning, is there a selling strategy from the listing agent right now that's hoping either for a bidding war, or they're expecting to list high and have somebody come in a bit lower, which is what tends to happen, and for them to basically continue the negotiation process that way. So I'm not able to comment on that yet. Once you got the comp done, then you are able to do it that way, okay? You're able to choose a way that is going to be conducive to your negotiation process when it comes to the purchase price, because your purchase price ultimately will also determine your debt servicing and your final calculations. So I basically just want to walk you through this entire thought process. It's a very small property, so it's actually quite straightforward in this particular case. And again, if you want to move on with this particular deal and you have any progress you want to continue to share with me so that I can leverage this opportunity to share with others as well, feel free to keep us posted. So on that note, I hope that this was helpful. And if you like this episode, make sure you hit like and share it with whoever you think can benefit from it. And with that said, remember, there is a coffee chat this Saturday in 2 days now on July 22nd at 11 a.m. Eastern Time, 9 a.m. Mountain Time, 8 a.m. Pacific Time. And a bunch of us are going to be on the panel. And we are all financially free and financially independent through investing in real estate. And we're going to be sharing a little bit about our journeys and stories, and each of us, the 3 key ingredients from our own perspectives of how we succeeded in leveraging real estate investing to contribute to our financial goals. And also, lastly, I have decided that my Daily Dose with Tim this season will be ending after episode 60. And so on that note, what that means is the last episode is going to be happening on July 28th. If there are any questions that you would like me to address, make sure you continue to message me, engage with me, and I will be more than happy to leverage the opportunity to do so. So with that said, have a great rest of the day and live well, everybody.